Brent crude jumped to around $80 a barrel as tensions escalate in the Gulf. Analysts now warn prices could move closer to $90 or even $100 in no time. The immediate concern is the Strait of Hormuz, a narrow waterway that handles roughly 20 million barrels per day, about 1/5 of global oil supply, along with a similar share of global LNG trade. Iran has warned vessels against transit, prompting tanker owners, oil majors and trading houses to suspend shipments through the route. While previous flare-ups saw price spike and then normalize quickly, early indications suggest this round of retaliation could be broader, raising the risk of prolonged disruption and a sustained geopolitical premium in oil markets. Country-wise, the dependence is stark. Saudi Arabia exports the bulk of its crude through Hormuz, although it can reroute up to 5 million barrels per day via its east-west pipeline to the Red Sea. Iraq, OPEC's second largest producer, exports most of its shipments through Hormuz, Kuwait, Qatar and Bahrain, and have no alternative export routes and are fully reliant on the waterway. For importers, China is the single largest buyer of Gulf crude, followed by India, Japan and South Korea. Much of their Gulf oil flows through this narrow 21-mile wide corridor. Qatar, one of the world's largest LNG exporters, also depends entirely on Hormuz for its gas shipments. Even if the strait is not fully closed, disruption could remove between 8 to 10 million barrels per day from global supply. Iran itself produces roughly 3.4 million barrels per day, accounting for about 4% of global supply. The country exports between 1 to 2 million barrels per day and mostly to China. OPEC moved to raise output by over 200,000 barrels per day, higher than anticipated but modest compared to the global demand. Analysts say that hike is unlikely to offset major disruption if Hormuz flows are significantly curtailed. An escalation with Iran also carries clear economic risks for the United States. Higher oil prices would quickly filter through to gasoline. US pump prices have been climbing in recent months. Higher oil could push prices back above $3 per gallon. Affordability remains a key political issue for Donald Trump. Any sharp increase in fuel costs could add pressure on consumers and weigh on economic sentiment. While past conflicts saw oil prices spike and then normalize, this time retaliation appears broader. If energy infrastructure or shipping lanes face prolonged disruption, the economic consequences could be more lasting and politically sensitive.